In this video, we will demonstrate the purchase of 100 bottles of shampoo at $3 per bottle, and on January 28, an additional purchase of 300 bottles of shampoo at $3.50 per bottle from the same supplier, in this case, Colgate Inc. So let's continue to watch the video and see how the accounting is taken care of. First thing we need to do is go to purchases, and in this case we're going to purchase from Colgate, and the item that we're going to purchase is shampoo, 100 units at a price of $3 per unit. Total cost $300. We get a Colgate invoice, and we will see what the transaction is when we process this. Here we go. Merchandise inventory of $300 and accounts payable of $300. We're paying this transaction at a later time. So let us process this purchase. Later on, we will make another purchase on January 28. Sorry, all this, and again, purchase. We're buying again from the same supplier, Colgate. This time, the same product, and I believe we're buying 150 units. The price increased to $3.50. Total purchase price of $525. Obviously, if we make another purchase, probably a different invoice number, obviously. And if we would look at the transaction, the computer system will always do the same transaction. Debit merchandise inventory on the balance sheet and credit accounts payable Colgate, because we're paying at a later date. So let's process the transaction and say OK. Now, what happens? Sometime, this happens every day, but for teaching purposes, we're going to assume that on January 30th, a customer walks in and decides to make a purchase. In other words, Walmart, the company, is making a sale. How do we record that? We don't say pay later, because the customer either going to pay us by debit card or credit card, etc. So we're going to take a one-time customer. What is the customer going to buy? In this case, we said shampoos. How many? 2. The selling price is $10, and obviously two items at $10 each gives us $20. That is the total amount that the customer will pay. Well, what is the system transaction? Here we will demonstrate it. System transaction is that we will receive $20 from the customer. We will have recorded a sale of $20, and we have cost of merchandise $6.60. We're going to check this out to make sure that it is the average cost. And merchandise inventory will reduce $6.60 from our balance sheet. So our inventory amount will decrease. Now let's process the transaction. Once we process that transaction, what will happen to our income statement? Well, let's have a look. Let's go to the income statement directly from the beginning to the end, and I'm going to hide the zero balances. Here we go. The sale of $20, as we all know, is a credit balance. And my total cost of goods sold of $6.60. The system, again, is not designed to read gross profit, but this is exactly what it will be. Total revenue of $20 less my cost of goods sold of $6.60 will provide me a gross profit. This should read gross profit at $13.40. Now, what happened to the inventory? Well, if we go to the inventory on the balance sheet at the end of the period, well, let's find our inventory. Here we go. Merchandise inventory. I'll click on it. I'm going to see the general ledger. We made an initial purchase of $300 and a second purchase of $525, total $825. And now we are decreasing 2 units at $3.30. $3.30 is the average cost. The system calculates the average cost for you. And the entry for this, obviously, was debit the cost of the merchandise as an expense and credit the merchandise inventory $6.60. Thank you.